Hello, everyone, and welcome to the BP Learning Channel. Today, we're going to talk about what I like to call the river of value in a business, net income, or in simple terms, revenue minus expenses. This information, if managed properly, helps an entrepreneur manage and grow a business and maximize its value. An excellent goal, right? Who wouldn't want to grow successfully like this? Make a good living, retire early, maybe even get rich someday. That's the question we're going to ponder today because 99% of the clients who come to see me are managing their business with a net income statement that doesn't make sense to them. I'm Debbie, a certified SBDC coach at the Business Incubator. The Incubator is a partner with the Colorado Small Business Development Center under the SBA or U.S. Small Business Administration. I'm also a former business owner myself, a former CFO for multiple startup ventures in the Silicon Valley, and a CPA with a master's in finance. That's me, folks. And I'm here today to help you understand how to maintain and interpret an income statement that you can use to manage your business, grow your business, and measure success. Maybe even exit the business with a healthy nest egg. And then we will circle back and answer the question I just introduced. As an aside, I will be using some terms I introduced in another session called Two Critical Concepts. The link is provided below for further reference. And now, let's get started, folks. Let's talk about the river of value so you can see why the income statement flows downstream. The river of value consists of all the pieces of net income that flow downstream in the form of a multi-step income statement. Revenue is the source or headwater of this river. Money flows in from the sale of product or services, and as it comes in, some of this money flows out to cover the cost of delivering those products and services. The goal is to keep this river flowing. Make sure there is ample revenue flowing into the river on a continuous basis to cover the costs flowing out. Cost of sales are the direct costs of delivering a product or service to a customer. Gross margin, sometimes called gross profit, is equal to revenue minus cost of sales. It's step one of the multi-step income statement, a number that can be used to measure the performance of a business based on the direct cost of getting a product or service out the door. Operating expenses consists of all of the indirect costs of getting that product or service to a customer. Operating income or operating loss, often called operating margin, is step two of the multi-step income statement. It's equal to gross margin minus operating expenses, a number that can be used to measure performance of a business based on all of its operating activities, both direct and indirect operating activities. Other income and other expense are non-operating activities. These are items that are not necessary to the core business. Net income or net loss is step three of the multi-step income statement. It's equal to operating income or loss plus other income minus other expense. It's a number that can be used to measure the overall performance of a business, all of the operating and all of the non-operating activities. These are the pieces, folks, all of the pieces that flow downstream. The income statement helps us monitor this flow from top to bottom using a 3-step segmented format. The goal is a healthy business over the long haul. Money flows in and money flows out. Let's take a look now at the source of all of this: revenue. Revenue and sales, two very similar items, almost synonymous. Revenue is equal to the total amount of money from operations over a period of time. Sales is equal to the proceeds from selling the products and services to customers. Again, they're almost the same thing. Revenue, however, might include something like shipping income from the customer. Rivers always flow downhill. Most begin their life up in the mountains and hills of the world with downpours of rain and melting snow. Revenue is the rain and snow up at the top of the mountain or hill. That's how I see it. Revenue flowing into the river from customer sales of various products and or services. The goal is to keep this river flowing by knowing your market, what you are selling, and who your customers are. Know your market. What does that mean? What are you selling? Who are you selling it to? How much will it cost? How much will you sell? What type of customers are available? Where are your customers located? Do you have customer projects? In order to have this knowledge, you have to do some homework. Let's do the homework. Let's do some industry research. And let's do some trend analysis. That's how we will understand the market dynamics. Customer concentration, seasons and cycles, geographical diversification, the size of the market, how much you can capture of this market. And then, after you have all this information, you need to set up a system to track all these things. Next up is cost of sales. Cost of sales versus cost of goods sold. Both are direct operating expenses. Cost of goods sold, often referred to as COGS, is related to the manufacturing of goods sold to customers. COGS is primarily used by manufacturing and industrial companies that have tangible products like cars, clothing, food, furniture, and equipment. Cost of sales, sometimes called COGS, represents how much a retail or wholesale business spends on the products it purchases from suppliers for resale. Cost of sales is more relevant for service-oriented companies who sell products made by manufacturers. Often, these products are sold in a shop or a store. Both cost of goods sold and cost of sales include similar costs, all directly related to delivering the product to a customer. Manufacturing companies have raw materials required to produce the product. Retailers and wholesalers have product costs that they have to pay to suppliers. Both cost of goods sold and cost of sales include other direct costs like labor, overhead expenses, packaging, and shipping, all related, again, to delivering the product to a customer. These terms are practically interchangeable. Importantly, cost of goods sold and cost of sales are direct costs. If there is no sale of a product or service, then there is no cost. And now, let's move on to gross profit or gross margin, step 1 of the multi-step income statement: revenue less direct operating expenses. Revenue minus cost of sales or cost of goods sold equals gross profit. Gross profit is one of the most important indicators of a company's financial performance. It allows a business owner to feel the pulse of his or her business and measure performance using a key margin ratio relative to competitors. Let's see how this works. In this case, there is revenue of $1 million, cost of sales of $300,000, and that leaves a gross profit of $700,000. If you divide $700,000 by $1 million, you'll get a gross margin of 70%. This means that 70% of the revenue remains after the direct cost of sales. Healthy ratios vary from industry to industry. The higher the margin, the more capital a company has to grow and maximize value. Bankers and investors focus on this critical key performance indicator, called a KPI. Every business owner should monitor this benchmark on a regular basis. Next up on the list are operating expenses, the indirect cost of a company's operating activities. Indirect is the key word here. Operating expenses are costs to operate a business that cannot be easily tied to a specific project, product, or service. These costs do not directly relate to production. They can be fixed, costs that are not related to the level of goods or services, such as rent, or they can be variable, a cost that varies indirectly with the level of output, such as advertising. The more you advertise, for instance, the more product or service you should be able to sell. The major categories of operating expenses are advertising, general and administrative, depreciation and amortization, bad debt, selling, and research and development. Each category can have many subcategories or accounts. The more detail you have, the easier it will be for you to manage your costs. More is better. You can always condense the information later on in a report. But if you don't track the detail right from the start, it's very difficult to recreate historical data later on when you really need it. So, be thoughtful about what you need to manage your business. Take the time to plan for what you need using the major categories I gave you off to the left here. Set up a good chart of accounts with a budget, and then be diligent. Use it properly. Remember, the more information you have, the better. And now, we'll talk about step 2 of the multi-step income statement. Operating income or loss, a number that is equal to revenues less the total of direct and indirect operating expenses. Operating income or loss allows owners, analysts, bankers, and investors to review a company's financial performance based exclusively on operating activities. Notice off to our right, we only have the operating activities here, and the two gentlemen up at the top are measuring performance. Operating activities are segregated from non-operating activities. The premise is that a business should be profitable and sustainable before any non-operating activities, other income, and other expense are considered. In other words, the financial health of a company and its value should be dependent upon stable and growing operating activities. If it isn't, the company may have a going concern problem. That is, it may not be able to meet its financial obligations and continue its business in the foreseeable future. Other income and other expense are non-operating activities. These items consist of a group of non-operating accounts that contain income and expenses not directly related to core day-to-day operations. These items may be either recurring or non-recurring, while operating income and expense is always recurring. Non-operating other income and other expense includes gains and losses from the sale of assets, interest income and interest expense, foreign currency translations, lease revenue, and one-time events outside of routine operations. Importantly, these items are all ancillary items, and as such, they should not significantly impact financial performance. They should be secondary when it comes to priorities. Finally, we get to step 3, the net income segment, a number that's equal to total income less total expenses. Net income allows owners, analysts, bankers, and investors to review a company's total financial performance, operating activities, both direct and indirect, and non-operating activities, other income, and other expense activities. Interested parties can review trends and benchmark results with the relevant industry, with competitors, and versus alternative investment opportunities. Operating income or operating loss and the gross margin are performance measurements of operating activities. Importantly, operating activities should represent the majority of net income. The business should not be dependent upon its non-operating activities, which are often non-recurring and volatile. The gross margin segment and operating income loss segment should be within a reasonable range of the industry standards, depending upon the size of the company and the number of years in business. As a refresher, let's review the 3 steps in the income statement. Step 1 is a measurement of direct operating activities. It's called the gross margin. Step 2 is a measurement of direct and indirect operating activities. It's called the operating margin. And step 3 is the net income. It's the overall performance measurement of the business. And now, let's take a look at an income statement and put all of these pieces together. Let me start by saying that this is an audit-ready income statement, which means it presents the net income flow down the river on a steady state basis using GAAP, or generally accepted accounting principles. Revenue and expenses are recorded as they occur, even if the cash has not yet been paid or received. Not only can you better manage your business with a statement like this, but now you are also ready for an independent audit should you need one to get a bank loan, comply with contracts, or do a public offering of stock. Let's follow the river downstream now, starting with revenue, the headwater, and ending with net income. We're going to put some numbers now to the multi-steps in the income statement. Beginning with step 1, gross profit or gross margin. Here you can see the difference between revenue and sales. Revenue consists of the sales for products of $1 million, reduced by allowances for returns and discounts of $50,000, increased by other income related to leases and royalties of $25,000, to get to total revenue of $975,000. Then, revenue is reduced by cost of sales, $300,000, to get to the gross profit of $675,000, which is 69.2% of total revenue. This is the direct operating measurement of direct operating performance. Next is step 2, operating income or the operating margin. Gross profit is reduced by operating expenses, all of the basic items we talked about earlier, equal to $335,000 or 34.4% of total revenue. Operating income, after you deduct the operating expenses, is $340,000 or 34.9% of total revenue. This is the direct and indirect operating measurement of total operating performance. And finally, we have step 3, net income or net income margin. Operating income is increased by other income and expense, lease revenue, interest income, gain on sale of assets, and interest expense for a total of $18,000 or 1.8% of total revenue. Then, after income tax is applied, we get to the final net income of $304,300 after tax. 31.2% of total revenue. That's what's left. This is the operating and non-operating measurement of performance overall. We're going to take that income statement now, make some adjustments to get to an adjusted income statement that includes two value-based numbers called EBITDA and free cash flow. We will start with the income statement and remove non-cash items, depreciation and amortization of $50,000. We will also remove all of the non-operating activities of $18,000, all of the other income and other expense items. I drew a red box around the operating activities, the core business activities. EBITDA is essentially operating income after non-cash items are removed. It consists of only the core business activities. It equals earnings before interest, taxes, depreciation, and amortization. In this case, EBITDA is $390,000. If you take that EBITDA number times an industry multiple of 5, $390,000 times 5 equals the value of this company of $1,950,000. Let's take EBITDA now and subtract any capital expenditures, in this case, $10,000, that might be required in the current year to get to a number called free cash flow, $380,000. Free cash flow is essentially EBITDA less capital expenditures. Technically, it is equal to operating income less non-operating items less capital expenditures. Free cash flow is an important number because it helps you determine if a company is able to expand or restructure. More free cash flow means a company can pay dividends, make debt payments, and grow. That's why owners and buyers focus on this number. And that's the two important concepts you need to know about value: EBITDA and free cash flow. Okay, that's a whole lot of information about the river of value. Information an entrepreneur needs to know in order to manage and grow a business and maximize its value. And that brings us right back to the question I asked you today when we first got started. Why? Wouldn't a business owner want to grow successfully, make a good living, retire early, maybe even get rich someday? It seems like they should, right? So what is the problem? Well, I believe the answer is something simple. They just don't know what they just don't know. Let's meet Edna so you can see what I'm talking about. She doesn't know what she doesn't know. How to use an income statement to manage her business. What gap basis accounting means. How to measure business performance and how to value a business, or why it's important to maximize earnings. For her, it's all about filing a tax return at the end of the year, and the goal of keeping a good set of books is minimize what you owe the government every year. It's a tax basis mindset with a mission that is very different than what we've been talking about today, maximizing business performance. Folks, when you minimize tax expense, it results in lower net income and lower value. That's the tax basis mindset. When you choose to maximize your business performance, it results in higher net income and higher value. This is an entrepreneurial mindset. The good news is that now you know what Edna doesn't know, which means you can choose what kind of business owner you want to be, what kind of mission you want your business to have. Yes, you get to choose. You get to answer lots of questions. Questions like, how much money do you want to make? What's the overall plan for your business? And what kind of exit strategy do you have? Your mission will drive the type of business owner you are. Are you in business simply to make a decent living and work for yourself? Maybe pass the business on one day as a family legacy, or maybe just wind it down when you retire. If this is true, and you're really sure that this is your goal, you won't change your mind, then you are a tax-minded leader. And your mission is to minimize taxes. Or are you in business to thrive and grow? Sell the business someday or do a public offering of stock, maybe get rich. If you are, then you are an entrepreneur at heart, and you need to focus on maximizing business performance, which means you might not always be able to save a whole lot of money on taxes, and you need to be diligent about keeping a good set of management books so you can grow on a sustainable basis, benchmark performance, and be audit ready. Or are you somewhere in between these two? You want to make more than just a decent living, more than what you can make working for somebody else. You're hoping to scale your business successfully, maybe sell it someday and walk away with a generous profit, but you're not really sure if you have what it takes to make this happen. If this is you, then you're what I call a borderline entrepreneur, and you need to do everything an entrepreneur at heart should do. Focus on maximizing business performance. In wrapping it up, you now know what you need to know about maximizing business performance. You know what the river of value is and how to monitor the net income flow downstream using 3 very important KPIs or performance benchmarks. You also know how net income is used to calculate a business value using EBITDA, and why this thing called free cash flow is so important. You know how tax basis accounting might impact the mission you have for your business, how minimizing tax expense reduces the value and performance of your business, and that consequently, you, as a business owner, need to decide what the mission is of your business and what kind of business owner you want to be. Bottom line, entrepreneurs at heart and borderline entrepreneurs should be focused on maximizing business performance, willing and able to do everything it takes to grow and thrive. Minimizing tax expense should be secondary. On the other hand, tax-minded business leaders can chase after tax deductions all day long, focus on expensing everything under the sun. But if this is the road you choose, be sure that this is what you want to do. It's really hard to backtrack later, if you can backtrack at all. And that's it, folks. But before you go, take a look at all the strategic learning tools available for free on my website, projection models, and finance keeping templates, all to help you maintain a good set of management books and focus on business performance. And please, subscribe to the Butterfly's Paws Learning channel so you don't miss out on other prosperity tips that might be helpful. Thanks, everyone, for listening.